Investors are shaking off the trade figures. It seems like they're not focusing on faster than expected exports and also imports hitting a record, which I guess goes to this rebalancing act in China.
Yes, the economy is going well. Investors continue to worry about inflation. They can worry about the whole monetary policy in China, tight monetary policy continuing at the moment. We've been waiting for some time for seeing the numbers stabilize, which they are now doing. We saw it on Friday with the inflation numbers stabilizing.
Right.
And hopefully over the next few months you'll see the numbers continuing to come down. Inflation
showing
numbers
stability, some would say.
Yes.
All right, so that's why we have a story this morning on the Bloomberg terminal. Most read, in fact, saying that I guess those predicting a hard landing in China seems to be put on the side burners right now.
Yeah, I don't think you're going to have a hard landing, and we really don't think that's likely because China's got all the tools it needs to avoid it at any time. It's at the moment creating this environment where domestic consumption is growing, as you've just said with the trade numbers. You've also got tighter monetary policy coming through and working on both inflation and other aggregates. So we like what's happening, but the stock market continues to go down. It continues to see a derating, and we're at low levels while you have other countries like Thailand, which you were just talking, at highs.
Yeah.
So we think there's very good value there, but the difficulty is the market goes down, investors get concerned, and then you've got the additional worries of what's happening in Europe and the banking crisis that are happening there. So people have a reluctance to take risk.
Right. And they've been taking some out of the Dreyfus Fund, I should point out, as well. Just what about people redeeming? Do you feel like this is the end of the trend, that investors are so scared they want to take their cash out of funds? That's kind of petered out now?
That's petered out. We found that the redemptions have slowed down now, and that you're seeing people have a wait-and-see attitude now. They're not coming back yet to the market. They're putting their money in money market funds or bond funds or gold, as you said. But if you have the capacity to wait, average down, or just average into the market, these seem very attractive times because China's growth is there. The emerging markets are growing. The middle class is getting more money. Salaries are growing. You've seen it over a number of years, this happening. And this middle class consumption boom is going to be a very strong pull for the future.
So you're saying that markets are not pricing in the cheapness in China. Is that what you're saying? The value that there is there?
There is value there. They're pricing in the risk that people are worried about what's happening in the developed markets and worried about the financial sector, both in Asia because of what's happening elsewhere. So you had a derating at the moment.
Hugh, when we were going to break here, I guess we touched on what happened in Europe and what's happening in the U.S. How do you judge Chinese stocks? Do you use a different metric? Do you even, I guess, factor in what's happening elsewhere around the globe?
You have to factor in the demand side of it, the export side of it, but what we're looking at much more is the growth in the domestic sector. And so the growth that we're seeing, 9.5% real economic growth, we think is very compelling. The choice of sectors, whether it's energy sector, the coal sector, whether it's pharmaceuticals, consumer stocks, food, retail, all of this is very compelling, especially in the mid-cap sector, which has been derated and nobody wants to touch it. The large caps is where we're seeing everybody investing or staying. So the index is outperforming a lot of managers at the moment. The opportunities we see in the domestic sector, the consumer.
You talk about value and compelling value. So, I mean, is it still compelling, let's say, if Greece defaults?
Well, the problem is if Greece defaults, then you've got the banking worries in Europe. And then you again have lack of liquidity, lack of investors willing. And that's why bond yields in Europe, the Bund has come from 3 to 1.5%, why US Treasuries are so low at the moment.
Less than 2% for 10 years.
Yes, it's so low. And a lot of investors are taking risk off. So the sectors which don't have liquidity, that don't have that perception of risk, they're staying away from. Ironically, a lot of markets in ASEAN are keeping investor attention, Indonesia, Thailand, while those markets which have tight monetary policy at the moment, such as China, such as India, are being sold off. But we think that longer term, what they're doing in China is good. It means that later, that they can relax.
Well, when will we see these benefits of these tightening measures that we've been seeing, which is scaring investors away from the markets? I mean, when do you actually get a benefit as a person who's bought into Chinese stocks?
hopefully the inflation numbers over the next 3 months will start to ease. It will allow investors to say, okay, the tightening is over. M2 is at about 13% at the moment, which is the tightest it's been for 5 years or so. So when that happens, that inflation numbers can abate and start to...
So what, in less than a year? Is that what you're saying? 6 months?
Yes, by the end of this year.
You'll see gains, right?
Well, you should be seeing the inflation numbers coming down, people coming back into the market, seeing that the earnings, because at the moment there's a lot of questioning about the E, what are the earnings coming through? So I believe that by the end of the year this will be much clearer. So by the first quarter, investors will be more relaxed about the emerging markets.
And Hugh, I guess I'm going to ask you and Zeb, is the pocket square the new fad for men's clothing these days?
No, it's not always the case, but I'm sure Rishaad could be convinced to join the trend.
Yes, we're missing John out here, for God's sake. Yes.
Well, I've been missed out on a Monday afternoon. In fact.
Okay, well,
we are the new fashion.
Exactly.
We're going against the trend.
Yeah. I see.
It's Groundhog Day, isn't it?
Yes, it is. You mean 10 years ago?
No, I'm talking about thinking as weighty as that. Talking about, of course, what we're seeing in terms of the European debt crisis.
Yes.
Once again, is it inevitable that they have to default here? I mean, that seems to be the sort of consensus.
The difficulty is that you can't devalue. If it had been the drachma, the solution would have been simple. You devalue the currency. People domestically, it becomes an attractive country to visit because of the point of view of tourism, manufacturing, but you can't do that.
Yeah.
So you have to cut salaries. You have to cut all the things that are painful domestically. And so it looks like you have to either come out of the euro or...
But there's no mechanism for that. I mean, that's the thing, isn't it, Zeb?
Well, if you believe what Paul Krugman's writing, I don't know if you saw his most recent piece in the New York Times, he says that we could be days away from the collapse here, not months away. I mean, you say Groundhog Day, and we've been talking about this for over a year now, but in his estimation, the end is near.
Because of the euro you're talking about?
Yeah, and the reaction of policymakers there.
Yeah. One of the things that we saw in Asia during the Asian financial crisis was the recapitalization of the banks, the whole tightening that happened at that time. The reaction in 2008 was loosening, adding monetary. The restructuring of the banks didn't happen except in the US. We haven't seen that. And I don't know whether some of your guests coming on your show says the same thing, but we find that there is a feeling from Europe that they're not in such a bad position. The French banks who visit us say, we're okay for the moment, it's okay, we will get through this right down. I don't know what your guests are feeling, but there is a difference without here.
At the moment, because Moody's said in June they're going to downgrade, even though Moody's got a higher rating than Fitch and S&P on the French banks, they're going to downgrade SocGen by 2 notches.
Yeah.
But they have got exposure to the Greek bonds. The German banks have got exposure to the Italian bonds, and they've got Deutsche Bank down 8% on Friday, 9% on Monday. I mean, obviously for Asia, the impact is it's going to slow down global growth, but it does seem, with the Greek 2-year above 55%, it's inevitable the markets are pricing in default. If Greece goes, Ireland, Portugal, Italy's got problems, Spain's got problems.
And that's what's worrying the markets.
It's inevitable.
Well,
really
that's what's worrying the markets, and that's why, in the 2008 crisis, you saw it was self-fulfilling. The markets pushed down Morgan Stanley until it had to go to get a bailout from the Japanese. The worry now is it going to be self-fulfilling even if it's not necessary?
In your opinion, compared to the Asian crisis of 97, how dramatically bigger is this one in Europe?
Well, the Asian financial crisis, we had multi-currencies, so they could devalue, like I was trying to imply about drachma. The Korean won, the Indonesian rupiah, all devalued. Then the pain happened and the restructuring started. That's why you've got stronger... Indonesia is strong now at the moment. But you have to go through this process, and it's uncharted, and I think you just have to recapitalize. You have to recapitalize the banks to absorb the losses, and I think some of the banks are doing it at the moment internally, and I think other banks can do the same, international banks, but it's affecting liquidity here, and the reason our markets are going down is not valuations, it's not to do with the growth. The growth is going to be sustainable, but the problem is nobody wants to take risk, nobody wants to invest. It's a liquidity thing, but our valuations are attractive, Our growth is there, and therefore it's patience. That's what we need.
And John, you've been looking at Tim Geithner. He's, I think you were saying that people in the glass houses.
Yeah. Of course, he says that Europe must speak with one voice, which the US are, but the US have got bigger debt problems than Europe, never mind. But again, he was in fact speaking in Marseille about how Europe should reform, but you could argue, but saying on morning to Susan and Rish, that it's throwing a very large stone from a very glassy house, him commenting about the European debt crisis. But here is Tim Geithner.
Europe's still under enormous pressure, and they have a really very difficult, challenging set of problems they're going to have to deal with over a long period of time. And it's not just, of course, what's happened in Greece and Ireland and Portugal. I think the basic lesson of financial crises is you need two things for them to work. First of all, you need reforms that address the underlying problem, make growth stronger, fix weak financial systems. Those have to be very powerful, very credible, sustained over a long period of time. That is necessary, but it's not enough. Those need to be backed by very, very powerful, unequivocal financial force so that governments have the time to make those reforms work.
So here with Tim Geithner saying that, the US debt problems, the European debt problems, what do you advise your Asian investors to do, apart from be patient?
I think look for the value. A lot of investors are going for the yield stocks at the moment. The larger cap stocks people are buying, as well as those stocks and those sectors that are performing, the consumer sectors. But it's too comfortable. If you want to look forward from here and say, where is the growth coming from? You have to look through this and say in a year's time, where is that going to come? So some of the cyclicals which have been so badly hit, some of the engineering stocks, construction companies, those may provide the better returns. But patience, the comfortable area at the moment is look for yield, look for the larger cap companies. There's many, many companies providing very decent dividend yield returns, beating bond yields, and are well covered.
Well, let me just to add on to John's question. I mean, you've been 68% of your peers over the last 5 years. How have you done that? You can't get into yielding stocks. That seems to be where everyone's piling in.
Most of the time, we're in mid-cap stocks, mid-cap growth stocks, and that's out of favor at the moment, and they're getting sold down. And therefore, what we're doing is we're concentrating the portfolio on those companies that we have high confidence in, that we believe will come out of this well, and that telling investors to either be patient or to average in, to dollar cost average, because over the next 6 to 9 months, you'll see inflation numbers coming down. You'll see liquidity come back into the market. Right. The Chinese government take its foot off the brake because they've done all the hard work over the last 2 years. And I think they're in a very strong position to let the economy... And it's not going to be a hard landing. They don't need to have a hard landing in China. They want to have full employment. They want to encourage the West and the areas of the economy and the country to grow. And that's what you'll have, a balance with higher incomes coming through.